Welcome, dear students. Today we have a session on marketing of financial services in which we are going to study the other part of mutual funds. In the last lecture, we have tried to analyze introduction to mutual funds, its benefits, and regulatory structure. Today, we will try to understand the other parts related to mutual fund. We'll look into the greater details of what are the types of mutual fund based on fund scheme. They're classified as close-ended scheme and open-ended funds. Based on assets invested into, they're classified as equity fund, debt funds, and hybrid funds. Based on investment objective, they're classified as growth funds, income funds, and balanced funds. Similarly, there are specialty funds like index fund, sector funds, regional funds, and tax saving funds. Let us try to have a deeper understanding of different types of mutual funds in this video. First, let us try to understand the mutual funds which are based on fund scheme. Means when investors can buy the funds units and sell them. They are classified as close-ended scheme and open-ended scheme. Close-ended schemes are those schemes which have fixed maturity periods. They are open in the initial issue. Purchases can be made when they are open. Once the window closes, such schemes cannot issue new units except in case of bonus or rights issue. That means buying or selling of already issued units of the scheme on stock exchange when they are listed can take place. The word close ended means you can purchase only when it is an initial issue and they have fixed maturity periods. While open ended schemes are schemes that do not have fixed maturity periods, which also means that you can buy or sell units at NAV related prices from and to the mutual fund on any business day. Funds can issue units whenever it wants and generally they are preferred for their liquidity. Liquidity means whenever the investor wants, he can sell it, redeem it, and get the money out of the investment he has done in case of open funded schemes. Open-ended schemes are highlighted as they can be issued and redeemed units at any time, which is not the case when we look into close-ended scheme. In case of close-ended schemes, they have fixed maturity periods and can be purchased only in the initial offers made. The advantages of open-ended funds over close-ended can be put into two things. One, investors can exit anytime they want, and investors can enter anytime they want. That is what is a basic advantage which is offered by an open-ended fund over a close-ended. Means if I wish to purchase or invest in open-ended funds, dear students, I can invest anytime, but when I want to invest in a close-ended funds, I would be investing only when it is offered. That is what is a basic difference between an open-ended scheme and closed-ended scheme. If you try to analyze that or compare that in terms of liquidity, liquidity is very high in case of open-ended funds and is lowest in case of closed-ended funds. Let us try to understand the other classification also. The second classification of mutual funds is based on the assets in which it is invested. So depending upon the assets, there are three types of assets like equity, debt and hybrid. Similarly, depending upon the assets in which it is invested, funds are classified as equity fund, debt fund and hybrid fund. What is equity fund? Equity funds are those funds that will invest only in stocks. As they're going to invest in stocks, there is high risk as well, there is a high return fund categorization. They promise high returns over a long term. Examples of this type of funds are index funds, sector funds, and tax saving schemes. Debt fund. Debt funds are funds which are investing in debt market instruments like bonds, government securities and debentures. Debt instrument because they are kind of borrowing mechanism for companies, bank as well as the government. And the benefit is here the interest payments are fixed as well as the return of the principal amount. Hence, debt funds are considered low risk, low return financial asset. Examples of which are long term investment, short term debt investment, as well as gilt funds. The third type is called as hybrid. As the word hybrid suggests, it is a combination in which the funds which invest in both equities as well as debt instrument. They are less risky than equity funds, but more than debt funds. They give you higher returns than debt fund, but lower than equity funds. Means if you want to categorization, highest risk funds would be equity, then hybrid, and then debt. Less risk funds would be debt fund, depending upon the investor profile he would like to invest upon. Let us try to understand the other classifications of mutual fund. The next classification of mutual fund is based on investment objective. If you try to analyze, an investor basically has three objectives in front of him. One, he would like to make profits from the investment made. Second, he would like to increase the wealth. And third, he would have or create a regular secondary source of income with respect to investments he has planned. Growth funds are the funds which promise capital returns in long term. They usually invest in equities and usually are high risk schemes. Fixed income funds, as the name suggests, schemes that promise regular income for a period of time. Fixed income funds are usually a kind of debt fund. This makes fixed income funds low risk schemes which are unlikely to give you a large amount of profit in long range. Third, depending upon the investment objective, balanced funds are the schemes or funds that try to strike a balance between risk and return. They do so by investing in both equities and debt instruments. The risk is lower than equity or growth funds, but higher than debt or fixed income funds. Also, let us try to understand what are the mutual funds which are categorized as special funds. These are funds which invest in a special kind of asset. That asset can be a kind of equity or debt fund. Index schemes. Indices are also formed to monitor performance of a company in a specific sector. For example, Tata Consultancy Services is a company and the sector would be IT, information technology. So these are the funds which will try to make us understand what is the performance of an index that is in a specific sector. The value of the index has direct relation to the value of the stock. If index goes up, the stocks are also going to go up. That is what is a benefit when we talk about index scheme. Second is called as real estate funds. These funds invest directly in the real estate. They may be by buying property or funding the real estate developers. Means I'm going to fund those people who are going to invest their money either by buying the property or going to invest in a property or funding the real estate developers. These are those types of funds. Gilt funds. They're those funds which primarily invest in government security. This is usually a credit risk free. There is 100% chances that you are going to get a fixed return. Then you have interval schemes. This schemes combines the feature of open-ended and close-ended scheme, a combination. They may be traded on stock exchange or may be open for sale or redemption during predetermined intervals at NAV based prices. Sector funds. These are kind of equity scheme restrict their investing to one or more predefined sectors. Sector means if I invest in pharma sector, I wish to invest in pharma sector, it would be investing in equities of only pharma sectors. Such types of mutual funds are called as sector funds. There are also mutual funds available which are invested with the purpose of tax saving. So such funds are called as tax saving schemes. They invest in the equity market through the equity linked savings scheme by offering them a tax rebate. And also there is a fund which is called as money market scheme. It is nothing but a kind of debt fund which invests in short term instruments. There are various short term instruments in the case of money market like commercial paper, certificate of deposit, treasury bills, and overnight money. This is nothing but short term maturity. They generally of 91 days where people invest and they will get returns after the fixed period on the investment. That is what is called as money market schemes available. These are nothing but special funds which are of interest. Moving forward, let us try to understand a concept called as hedge fund. What is hedge fund and what is a mutual fund? Is there a difference between hedge fund and mutual fund which can be further clarified from the diagram?